Hello everyone, welcome to EduTap and welcome to the Finance 360-degree session. In today's session, we are going to discuss three very important news articles. The first one is regarding the Trinidad and the Tobago that has joined the global UPI network, okay? And it has become the first Caribbean nation to join the UPI ecosystem. We will discuss about the other 8 countries also that have previously joined the UPI ecosystem, okay? So this is important. Direct question can come in your phase 1 or the phase 2 of the examination, okay? So this is the first news article. Then the second news article is regarding the SEBI. The SEBI board meeting happened, and in that it is decided to bring some changes in the REITs and the InvITs in the real estate investment trusts and the infrastructure investment trusts. So what are the changes that have been brought, that we are going to discuss, as the REITs and InvITs, they are very important for the RBI examination also. As you know that in the previous RBI grade B examination, there was a direct question from the SM REIT, okay? So that's why the REITs and InvITs, they are important, and we are going to discuss about the changes that the SEBI has brought in the REITs and InvITs. The third news article is again important. It is regarding the gold that has topped the euro as the second largest reserve asset. So dollars is the first largest reserve asset. After that, gold is there, that has taken the second position, okay? So what are the percentages in the reserve asset? All of this we are going to discuss in today's session. Okay, so good morning everyone. Thank you for joining the session, and give me a thumbs up if I'm clearly audible and visible. And in today's session, we are going to discuss these 3 news articles, and I will show you the questions at the end, that what kind of question can come from these 3 news articles. Just give me a thumbs up if everything is fine, and let's start with the session. But before that, do join the YouTube channel of EduTap. Do subscribe to the YouTube channel of EduTap if you have not done it till now, so that you continue getting the relevant videos, and join our Telegram channel where you will get the PDF of the session, and the link for the Telegram channel of EduTap is provided in the description box below. Okay, so let's get started with the first news article. See, Trinidad and Tobago has become the first Caribbean nation to enable transactions through the India's Bheem app using the UPI. Okay, so here you can see in the world map, the Trinidad and Tobago is at this area. Okay, so they are the Caribbean. Trinidad and Tobago has become the first Caribbean nation to enable transactions through the India's Bheem app using the UPI. So Indian Prime Minister Narendra Modi has congratulated the country on adopting the digital transaction system via the Bheem app. So it is via the Bheem app that the UPI ecosystem has been adopted by the Caribbean nation. Okay. So now PM Modi, how it happened? Okay. So PM Modi visited the Caribbean nation Trinidad and Tobago from July 3rd to 4th at the invitation of the Prime Minister of Trinidad and Tobago. Now here in the phase 1, as you know that in the phase 1, the Prime Minister name can also come, that who is the Prime Minister of Trinidad and Tobago. So for the phase 1, this name can be important, that is Kamala Prasad Bise sir. Okay, so this name can be important for the phase 1, not for the phase 2, but for the phase 1. Okay, and the Trinidad and Tobago has become the first Caribbean nation to enable the UPI ecosystem. So this is important for phase 1 as well as for phase 2. Okay, so these are direct facts that can come in the objective part of the examination. Now the 2 countries have expressed, that is India and the Trinidad and Tobago has expressed strong interest in expanding the cooperation in the digital domain, and the 2 countries have agreed to cooperate in the areas of India's tax solutions, that is including DigiLocker, eSign and government e-marketplace. So the 2 nations also agreed to embark on further collaboration in the implementation of India's tax solution, that is the DigiLocker, eSign and the government e-marketplace. So DigiLocker, we all are somehow using it. DigiLocker is a system where we keep our documents, or where the documents are automatically kept. Like if you want it to access your Aadhaar card, if you want to access your PAN card, if you want to access your driver license and such, that you can do through the DigiLocker, just putting in basic details. Okay, now government e-marketplace, it is a one-stop portal to facilitate online procurement. If the government departments want to procure common use goods and services required by various government departments, they can do it through a one-stop portal, that is the government e-marketplace. Okay, so government e-marketplace, it is a one-stop portal to facilitate online procurement of common use goods and services required by various government departments or organizations or public sector units and such. So this is the idea. Any confusion here? Any confusion, anyone? Now coming to the 8 countries. So actually Trinidad and Tobago has become the 8th country to allow the UPI system. The 7 countries, the previous 7 countries are France, UAE, Bhutan, Nepal, Mauritius, Sri Lanka and Singapore. I have given you a basic detail about the countries that have joined the UPI ecosystem or how they connected with the UPI ecosystem. So the basic detail has been given that you can read. The most important point here is that the France in 2024 became the first European country to accept the UPI widely. So remember that the first Caribbean nation is Trinidad and Tobago to join the UPI ecosystem. France is the first European country to accept UPI widely, okay? But altogether, if we discuss about the first country that accepted the UPI ecosystem, it was Bhutan. So at the global level, Bhutan is the one that is the first country to adopt the UPI standards, okay? So Bhutan was the first country to adopt the UPI standards and the first country in the neighborhood also to adopt the UPI ecosystem, okay? So this is the idea. France is the first European country and the Trinidad and Tobago is the first Caribbean country. Now, if you want to read more about the other countries, UAE has also joined the UPI payments or has enabled the QR code based UPI payments where the NIPL, that is the NPCI, National Payment Corporation of India Payments International arm in partnership with Network International has enabled QR code based UPI payments across the UAE in 2021. In Nepal also NIPL, that is the NPCI International Payment Limited and PhonePe Payment Service Limited. PhonePe Payment Service Limited is the Nepal's largest payment network. In 2024, they joined hand to introduce UPI for cross-border transactions between India and Nepal. Then Mauritius has joined the UPI services or has inaugurated the launch of UPI services in Mauritius. Now, PM of Mauritius has also informed that the co-branded RuPay card are the indigenous card of India. So, RuPay cards have been designated as domestic card in Mauritius. So Mauritius has not only adopted the UPI services or has accepted the UPI services, but they have also allowed the RuPay card to become the domestic card in Mauritius, okay? Sri Lanka has also introduced UPI payments in Sri Lanka through the QR codes and such. Singapore, so NIPL, that is NPCI International Payment Limited in 2023 in partnership with HitPay, a Singaporean based payment infrastructure firm, expanded the UPI acceptance across the Singapore, okay? So this is the basic idea. These are the 7 countries that accepted the UPI ecosystem, and now the 8th country is Trinidad and Tobago, that is the first Caribbean country to accept the UPI system. Now coming to the second news article, that is regarding your measures to enhance the ease of doing business for the activities of REITs and InvITs. Any idea about the REITs and InvITs? Any idea, anyone, that what are the REITs and InvITs? So basically, like you have a mutual fund. In the mutual fund, there are multiple investors that can invest in the mutual fund, and then the mutual fund invests the money in the stocks, in the different instruments, in the different securities, right? So that is a mutual fund that is pooling in the money, that is collecting the money from the multiple investors and then investing that money in the securities, in the shares of multiple companies and such. Similarly, there is the real estate investment trust that pools in the money, that collects the money from multiple investors and that invests the money in the real estate, that invest the money in the buildings, in the residential buildings, in the commercial buildings, in different geographical locations. Let's say that you want to buy a property. Let's say you want to buy a building. Will you be able to buy a building that is of 20 crores, 30 crores, 300 crores? Would you be able to buy a building if you have 10 lakh rupees? Would you be able to buy a house or a flat in a good location? I don't think so, that with the inflation that is currently going on, and in a good location, if you want to buy a flat, you will not be able to buy it at 10 lakh, okay? But with the 10 lakh, you can invest in the REIT, and through the REIT, that is real estate investment trust, that is pulling in the money from multiple investors, the REIT can invest in the buildings, can invest in the residential areas, in the commercial plots and such, and the commercial buildings and such, and through the REIT, you can get the part of the ownership, or you can get the part of the building, we can say. Okay, so that is the real estate investment trust, that is pooling in the money from multiple investors to invest in the residential buildings, commercial buildings, and the other real estate. I hope this is very much clear. And the real estate investment trust invest in the buildings or invest in the real estate in the different geographical locations also. Now InvIT, again, if you want to invest in the infrastructure projects, the infrastructure projects are of 1,000 crores, are of 100 crores and such. So we don't have that much money, but we want to have some access to the infrastructure projects, because we know that the infrastructure projects, they are very profitable, or they are profitable in the long run. Okay, so many investors, they want to invest in the infrastructure projects, but they do not have huge money to invest 100 crores, 50 crores or such huge amount. So what they can do, that these investors, they can invest in the infrastructure investment trust, through which the infrastructure investment trust is pooling in the money from different investors, and then the pooled money is invested in the different infrastructure projects. So through the infrastructure projects, the people will get the investors will get the profit, or will get the benefit. Okay, so this is the basic idea. So I hope this is clear, that real estate investment trust pools in the money from different investors, and that pooled money is invested. That pooled money is invested in the real estate projects, in the buildings, in the residential buildings, in the commercial buildings and such. Okay. Now, if the investors, multiple investors has invested in the real estate investment trust, that is investing the money in the real estate, so the profits from the real estate, by selling the real estate, or by giving that real estate on rent, by giving the residential buildings on rent, so whatever profit is coming, that is shared between the investors after deducting the cost, after deducting the management cost and such cost, whatever profits are coming, that is shared with the investors. Similarly, in the InvIT also, the pooled money from the investors, it is invested in the infrastructure projects, and then whatever profits are coming from the infrastructure projects, they are shared with the investors after deducting the cost, after deducting the management cost and such. Okay, so this is the basic idea. Now what has happened, that the SEBI board meeting happened recently in June, and it was decided that there are some changes that has to be brought in the REITs and InvITs regulation. So there are amendments that will be done in the REITs and InvITs regulation of 2014. The proposals for the board were after due public. So the changes have been made after due public consultations, and based on the recommendations from the Hybrid Securities Advisory Committee of the SEBI, and after the public feedback. So after the public consultations, after the consultations with the stakeholders, and after the recommendations taken from the Hybrid Securities Advisory Committee of SEBI, and after the public feedback has been received, then there are the changes that have been done, or the changes that have been notified in the REITs and InvITs directions. Okay, so understanding the REITs and InvITs, so basically they are the investment vehicles that allow the investors to invest in real estate and infrastructure assets, infrastructure projects respectively, without owing the physical property. Because let's say the building is of 10 crores and you are investing 10 lakh rupees, you are investing 20 lakh rupees. So a very small portion, you only have fractional ownership. A fraction, let's say 10% of the building you own. So you actually do not own the whole physical property, you only have the fractional ownership. Okay. So see, there is a sponsor that has initiated the real estate investment trust. Okay. Now this real estate investment trust is investing in different projects, is investing in different real estate. So that should be owned by sponsor. No, that is not owned by sponsor, because otherwise the sponsor will take away the money and will run away. So actually, when the sponsor initiates a real estate investment trust, there is a trust that is established that have multiple trustees, and this trust owns the real estate properties on behalf of the beneficiary unit holders, that is on behalf of the investors that are holding the units in the real estate investment trust. I hope this is becoming clear, that there is a sponsor that has initiated the real estate investment trust. Now the trust owns the real estate properties here on behalf of the beneficiaries, on the behalf of the unit holders, that are the investors that are holding the units in the real estate investment trust. Let's say someone has invested 20 lakhs, someone has invested 50 lakhs. So as per their investment, they are holding units in the real estate investment trust. Okay, so the trust owns the real estate properties on behalf of the beneficiary unit holders and is responsible for protecting the interest of the unit holders. That is the basic idea. So there is a trustee that is established. Okay, the manager is responsible for the day-to-day operations. So the investment manager or the other managers, they are responsible and they are vested with the responsibility of managing the real estate portfolio. Such a tripartite structure, that is, sponsor is there, that is establishing the real estate investment trust. Then there are the trustees that are handling they are like looking after the benefits, or they are looking after the interest of the unit holders, and there is the manager, investment manager, that is doing the day-to-day operations of the real estate investment trust. So this is a tripartite structure that provides the safety for the investors. There is a sponsor, trustee, and investment managers or investment firm. Okay, so that is the basic idea. Any confusion? Yes, the recognized, see, basically in a financial market, if you are investing in stocks, it is not safe because there is the risk involved. If you are investing in debt securities, that is not safe, risk involved. In the REITs and InvITs also, there is risk involved. But if you are investing in the SEBI recognized REITs and InvITs, then at least they are trustworthy. That, okay, they are not going to run away with your money, but there is risk involved in this also, that what if the real estate project is not beneficial after the buildings have been made? It is not very beneficial because the people are not buying the flats, or the people are not buying, or they are not taking the flat for rent. Okay, so they might not be profitable. Okay, so there are risks involved in each investment that you do. That is the basic idea. Now moving forward with the changes that have been brought. So now coming to the guidelines or the changes that have been brought in the REITs and InvITs regulations. Okay, so let's understand that. So first of all, see, when a REIT or InvIT is listed in the stock exchanges, there is a regulatory requirement that a minimum percentage of the units must be held by the public, like the general public, like you and me. Okay, called public float, or the general public also means the institutions. Okay, so when the REIT or InvIT is listed, there is a regulatory requirement that a minimum percentage of the units must be held by the public, that must be held by the entities in the country or the people in the country and such. Okay, now what happens that these entities, they will not be counted as public. That means the units held by sponsor, the units held by the sponsor group, that means this sponsor, let's say Reliance Industries, they have opened their real estate investment trust. So the group of the Reliance Industries, the Geo Financial and the Reliance Power, they are of the same group, right? So this sponsor group or the group that the sponsor belongs to, they will also not be considered the public because they are investing. The other entities in the group, they are investing because the sponsor is related to the same group of the companies. Okay, units held by the sponsor, units held by the sponsor group, they will not be counted as public, as well as units held by the investment manager or the project manager or the manager. So they will also not be considered as public because they are directly related to the real estate investment trust. Now the point is that the units held by the related parties of any of the above, you can understand that the related parties of the sponsor group, investment manager, project manager, so the related parties of any of the above, they will also, if they are investing in the real estate investment trust or infrastructure investment trust, they will also not be counted as public. So what was happening, that so many of the entities, they are not getting counted as the public. So the real estate investment trust and the InvIT, the REIT and the InvIT, they were not able to achieve their minimum percentage of the public float. So that's why there is the relaxation that has been provided. Now it has been said that the related parties of the REIT or InvIT, the related parties of the sponsor, investment manager or manager, they and the project manager, they shall not be considered as public unless such related parties are qualified institutional buyers. That means if the related parties, here in just the related parties we are talking about, so these entities will still not be considered public, but it is said that the related parties, if they are qualified institutional buyers, then they can be considered as public. Then they can be considered as the public, and then their investment can be considered in the minimum percentage of units must be held by the public. Okay, so the related parties of the REIT, InvIT, sponsor group, investment manager, they shall not be considered public, but if they are qualified institutional buyers, then their investment in the REIT or InvIT can be considered as the public. Okay, I hope this is clear. So the sponsor group, now I have told you sponsor group, investment manager, project manager, they can never be considered as public even if they are the qualified institutional buyers or not. So basically, prior to the amendment, any units held by the related parties of the sponsor, investment manager, project manager, they were not considered towards the units held by public, but now it has been clarified. Now the relaxation has been provided. That the amendment aims to facilitate classification of units held by the related parties. Only the related parties, they who are the qualified institutional buyers, they will now be considered as public. Okay, I hope this is clear. Any confusion? Qualified institutional buyers are the big institutional buyers that invest more than a certain percentage. Okay, so this is the basic idea, that still units held by the sponsor group, investment manager, project manager, they will not be considered as the investment done by the public. But if the investment is done by the related parties who are the qualified institutional buyers, then the investment done by them will be considered as the investment done in the public domain. Okay, this is the idea. Now coming to the second point. Remember that the REIT can invest in the residential buildings in the different geographical locations, can invest in the commercial buildings in the different geographical areas, and other real estate can also be there. Okay, like the flats and some houses and such in the different geographical areas. Now the REIT is investing in so many of the projects. What if that the investor wants to invest in the residential buildings and the residential buildings are profitable, but there is losses that are happening through the commercial areas or through the commercial buildings. So this losses will transverse to the investors that have invested in the residential building also, because the real estate investment trust, it is seeing that how much profit it has gained, 100 crores, how much losses it have gained, 150 crores. So the real estate investment trust is having the negative of 50 crores. So the profit that is coming in the residential buildings is not going to the investors, because anyway the profits are used for covering the losses. But the investors are saying that we wanted to invest in residential building and that is profitable, so we should be getting the profits because we have invested in the right place, that is residential building. The losses should go to the investors that invested in commercial building because they took more risk. Commercial buildings are more risky. Why are we handling the losses when we have invested in the residential building? So real estate investment trust, what they can do, real estate investment trust, to like segregate the financial losses or to segregate the financial risk, they can have a special purpose vehicle, that is a subsidiary company that is investing in the residential buildings, let's say in a particular geographical area. Another special purpose vehicle can be opened to invest in the residential building in other geographical areas. Another special purpose vehicle, that is a subsidiary company, can be established, or special purpose vehicle can be established for investing in commercial buildings in some other area. So now the financial risk have been segregated, because whatever loss is coming from this commercial building will be handled by this special purpose vehicle and losses will be there to the investors. Whatever profit is coming in this residential building will be handled by this subsidiary company and the profits will be provided to the investors. So basically when we talk about the real estate investment trust or infrastructure investment trust, there are the special purpose vehicle through which the investment can happen. Okay, so special purpose vehicle, it is a subsidiary created by a parent company. So here the real estate investment trust is the parent company that is opening the special purpose vehicle so that the financial risk can be isolated, can be differentiated, that okay, this project can have profit or loss, this project can have profit and loss. So whoever is investing in a particular project should get the benefit or the loss as per the project category. Okay, so this is the idea, that to segregate the financial risk, to isolate the financial risk in different categories, there are the different special purpose vehicle that the REIT can have. Now try to understand that a REIT can have a real estate investment trust or the InvIT. Okay, whenever I'm saying REIT, consider the same idea for the InvIT also. That InvIT or the REIT, they can have multiple special purpose vehicle, and it becomes hectic to handle so many of the special purpose vehicle. So what happens that the REIT or InvIT can have a holdco. Holdco means holding company that can have, let's say, REIT or InvIT. The REIT has 10 special purpose vehicle. So 6 of the special purpose vehicle are coming in the under the holdco. Now all of these 6 special purpose vehicle, let's say they are the residential, they are investing in residential buildings in the different geographical regions. Now there are this is one holdco. Now the other 4 special purpose vehicles are directly handled by the REIT directly. Okay, so they are investing in, let's say, commercial building and other projects. So this is the idea that a REIT can have directly, the REIT can have the real estate investment trust, can directly invest in the projects, in the real estate projects, or the REIT can invest in the real estate projects through the special purpose vehicle, that is a subsidiary company, to isolate the financial risk. Or there can be a holdco that can, so REIT can even have a holdco. If the REIT has a holdco, so holdco will hold a majority stake in some of the subsidiary companies. So some of these special purpose vehicle will come under the holdco, and holdco will be liable to handle the legal and the financial, will be able to handle the legal and administrative problems of this special purpose vehicles and such. Okay, and REIT can have other special purpose vehicle directly under it also. So I hope this structure, is it understandable a little? Any confusion here? So REIT can directly invest in the assets. REIT can have special purpose vehicle to invest in the asset so that there is financial risk that is segregated. REIT can have a holdco to under which there can be multiple SPVs. Holdco will be liable to handle the legal and the administrative problems of these special purpose vehicle. Okay. Now, so holdco is a holding company that holds a majority stake in the subsidiary company. Okay, so previously holdco was required to distribute. So what was happening that, let's say, under the REIT there is a holdco. Now holdco has its own expenses because the holdco has some employees, so the money has to be given to the employees. Holdco is handling the legal responsibilities, so holdco has to give the money to the legal employees also, or the legal branches also. The holdco is also looking after the administrative problems, so holdco has to give money for that also. So holdco has its own expenses. So sometimes the sponsor used to give money to the holdco, sometimes the investment managers used to give the money to the holdco, but there was no set pattern that how the money will go to the holdco to handle the legal administrative role or to handle its own operations. So usually holdco, whatever, now you will say that SPVs, if they get the profit, so holdco will get a cut, right? Actually what used to happen that if the SPVs are in the profit, if the special purpose vehicle have the profit, 100% of that profit had to be transferred to the REIT directly, so that the REIT can provide the profit to the sponsor and the unit holders. So this was a little problematic because the holdco was not able to take out the money for its own expenses, and the holdco had to depend on the sponsor or the investment manager to give some crumbs of the money. So previously a holdco was required to distribute 100% of the cash flows received from the underlying special purpose vehicles to the REIT or InvIT. Now this became a problem because the holdco was going in losses and it had to live on the crumbs that was given by the sponsor or the investment manager. So it was said that it is becoming problematic because the holdco is going into the losses when the REIT or the InvIT is making huge profits. So that should not be happening. Okay. So previously a holdco was required to distribute 100% of the cash flows received from the underlying special purpose vehicle to the REIT or InvIT. Now it is said that the negative net distributable cash flows, that is the shortfalls, losses or expenses that is coming to the holdco, generated by a holdco. So the negative net distributable cash flows generated by the holdco on its own can be adjusted against the cash received from the SPV to arrive at the cash flows for the distribution by such holdco. So basically it is said that now the profits that the holdco is receiving from the SPV do not have to be provided 100% to the REIT or the InvIT, whichever holdco it is of. So holdco can keep some of the money to handle its own expenses and to handle the negative of the negative net cash flow. Okay, so basically holdco for its own losses can keep some of the money from the special purpose vehicle. This is the idea. So the negative net distributable cash flows, that is shortfalls, losses, expenses that is generated by the holdco, can be adjusted now against the cash that is received from the special purpose vehicle to arrive at the cash flows for distribution by such holdco. Now it should be done only after disclosing this to the unit holders. That means unit holders that have invested in the REIT or invest must be aware about it, that okay, there is a holdco who is going to deduct some amount for its own expenses. This is the idea. Any confusion here? So now holdco can get some money from the special purpose vehicle. A part of the profit can go to the holdco, but appropriate disclosure should happen to the unit holders. This is the basic idea. Okay. So the above amendment aims to facilitate holdco to adjust its own negative cash flows against the cash flows received from the underlying SPVs before distributing such cash flows to the REIT or InvIT. Whatever money is going to be held by the holdco, or whatever part of the money is going to be held by the holdco, should be informed to the unit holders. Without information, the holdco cannot take out the part of the money. Okay, this is the idea. So this is the idea. Okay, now coming to the next part, very easy, directly alignment of timelines for submission of various reports. Before, various reports were given in different timelines, so there were different timelines were prescribed for submission of the various reports and the financial results. So there were different timelines for the submission of reports and the financial results. Now it has been said that the quarterly reports included disclosures of certain financial information, certain statements that provide the valuation reports. So the quarterly reports, the valuation reports, they should have a aligned timeline. They should have the same timeline. Okay, so it was represented that the timelines for submission of the above reports may be aligned with the timelines for submission of financial results. That means the reports that is the valuation reports and the financial information, these should be submitted at the same time. That's it. So before there were different timelines that were there. Now the timelines have been merged, or they have been aligned, that at the same time the reports and the financial information should go to the REIT and InvIT, or should go to the stock exchanges, trustee, board of the investment manager and such. Any confusion here? There is only one point left from this news article. So before there were different timelines for the reports and for the financial results. Now it has been said that we will merge, or we will align the timeline for the reports and the financial results, because if the report have been submitted, the financial results should be there to compare the report with it, right? Or to have the complete picture. Otherwise, just half of the picture is being provided if there are different timelines. So align the timeline so that there is the complete picture that is going to the stock exchanges or the trustee or the board of investment manager, whoever requires it. Now the last point is, try to understand that before, this is only for InvIT. Now this part is only for InvIT, this particular part. Okay, so previously the minimum allotment lot in the primary market for privately placed InvIT. Now there are privately placed InvIT. Privately placed InvIT means, this we have discussed in a previous session also. Privately placed means that only a number of the investors can invest in the InvIT, or the InvIT is open for only a set number of investors, that are the big investors. So the InvIT is not going public, it is not going to be offered to the whole of the public. It is only privately placed, it is only placed or for the set number of investors that can invest in the InvIT. Okay, so the privately placed InvIT, the minimum lot size that can be bought was rupees 1 crore or rupees 25 crores, depending upon the asset mix of the InvIT. Okay, the lot size for trading. Now this is for the primary market. That is, if the private placement of the InvIT is happening, then in the primary market, the lot size was 1 crore or 25 crores, depending upon the asset mix, that which are the projects that are in the InvIT. Now try to understand that this is in the primary market. Now in the secondary market, try to understand that the lot size was 25 lakhs. You can understand that if I'm buying a asset 25 crores and I'm only able to sell the lot of 25 lakh, so it is very problematic, because if I want to sell the part of the InvIT or I want to sell my units, then I will have to sell it in so many of the lots. That is very problematic. So the primary market and the secondary market was not aligning at all. It was not having the same kind of lot size. So this was creating problem for the investors. So basically previously the minimum allotment lot in the primary market for privately placed InvIT was 1 crore or 25 crores depending on the asset mix. The lot size for trading in the units of a privately placed InvIT in the secondary market was 25 lakhs. Lot size in the primary market for the privately placed InvIT is 1 crore or 25 crores, and in the secondary market 25 lakh. Even if I have bought the unit for 1 crore, I will have to, in the secondary market, I will have to create 4 lots to sell this 1 unit or 1 lot. So that was very problematic. Okay, that's why it is said that now the reduction of minimum allotment lot in the primary market has happened for the privately placed InvITs. Now the lot size in the primary market has reduced from 1 crore or 25 crores to 25 lakh to make it same for the secondary market also. Okay, so this is the idea, that the reduction of minimum allotment lot in the primary market for privately placed InvITs is done to rupees 25 lakhs in alignment with the trading lot size in the secondary market, so that the secondary market lot size and the primary market lot size can be aligned. Okay, hence a uniform minimum allotment of 25 lakhs in the primary market for all privately placed InvITs in alignment with the secondary market. So in primary market the lot size has reduced to 25 lakhs. I hope this is clear. Now coming to the third news article. Which laws, Mukund? Which laws? Which point? Okay, so this is the last news article, that is in regards to gold tops euro as second largest reserve asset. If anyone has any confusion in the previous news articles, kindly ask me. Primary and secondary market, there is no loss, but there is the difference in the lot size. So privately placed InvITs are the InvITs that are privately placed. They are only provided to a set number of investors that are usually the big investors. Okay. Now in the primary market, the lot size, that is the allotment size of a InvIT, one unit or one lot, is of 1 crore or 25 crores based on the asset mix or based on the projects. Okay. Now in the secondary market, the lot size was 25 lakhs. That means if I want to resell my lot that I have purchased in primary market of 1 crore, I will have to make 4 lots in the secondary market. If I have purchased a lot size, or I have purchased a lot giving 25 crores, so I will have to make number of lots in the secondary market to sell my lot. To sell my 1 lot that I have purchased in primary market, I will have to make nearly 40 or more than that. Nearly 80 or 90 lots I will have to make, 80 or 90 lots I have to make to sell the 1 lot that I have purchased in primary market. So it was becoming problematic, right? So now it is said that the primary market will also have the same lot size, that is 25 lakhs. That is the lot size in the secondary market. That is the basic idea. Now is it clear? Now is it clear? I don't think where I said loss, I might be saying lot and may have pronounced it like loss. It is lot. So previously the minimum allotment lot in the primary market for privately placed InvIT was 1 crore or 25 crores depending upon the asset mix, depending upon the projects. The lot size for trading in the secondary market was 25 lakhs. So there was a difference in the amount that was problematic. Now the lot size has decreased in primary market to 25 lakhs, so that there is alignment that has come, there is uniformity that has come in the minimum allotment size in the primary market and secondary market, that is 25 lakhs. Okay, now is it clear? Okay, now coming to the gold. Gold tops euro as second largest reserve asset. So a recent report by the European Central Bank reveals that gold has overtaken the euro. So before, what used to happen, that in the foreign exchange reserves, the dollars were the largest chunk in the foreign exchange reserves around the globe. Then there was euro, then there was gold, and so, okay. So foreign exchange reserves were kept in like the countries are keeping the highest foreign exchange reserves in gold, then euro, then gold. Now what has happened, that the gold has taken over the euro and has become the second highest or second largest reserve asset. So first largest reserve asset is dollars, and the second largest reserve asset now it is gold. Okay, so gold has taken over euro to become the second largest foreign exchange reserve asset. So dollars share in foreign exchange reserve is shrinking. Basically the dollars share in the reserves asset is also decreasing, and the gold share in the reserve asset is increasing. Okay, so basically, yet the dollar share in the reserve asset is 46%, the gold reserves in the foreign exchange reserves is 20%, and the euro is left behind at 16%. So basically, dollars, even though its share in reserve asset is shrinking, still the dollars is the highest reserve asset at 46% of the total reserve asset. Then gold is 20% of the total reserve asset, and euro is 16%. Okay, so gold has taken over euro in terms of the reserve asset that the countries are keeping. The clear message emerging from this data is that central banks are banking more on gold. They are trusting more on gold rather than euro denominated assets. Okay, globally the central banks hold 36,000 tons of gold, close to all-time high of 38,000 that was kept in 1965 during the Bretton Woods era. Within that, the US. So at the global level, the central banks are holding 36,000 tons of gold in their reserve assets, and out of which 8,133.46, the highest amount of the gold, is kept by the US Central Bank. India had 876.18 tons as of December 2024, which has increased by March 2025. By March 2025, the gold in our reserve asset has increased to 879.60. So you can understand that March 2025, by March 2025, India has the reserve asset of in the form of gold, that is of 879.60 tons of gold the Indian Central Bank has, okay, in its total foreign exchange reserves. Now the last point is that 95% of central banks, according to a recent survey conducted by the World Gold Council, believe gold reserves. So 95% of the central banks still believe that the gold reserves of central banks will increase further over the next 12 months, that is over the next year. Got it? Now, this is the first question. I hope you will be easily able to answer this question, and if there is any confusion, do ask me. And let me tell you that there is a Perspective 360-degree series that is on Monday, Wednesday and Friday. The Perspective 360-degree series is taken by Jaskran sir at 5 p.m. in which you get the answer writing practice. You get the descriptive questions from the recent topics, and the answers, that how you can write the answer, what points should be there in the answers and such. So that is discussed in the Perspective 360-degree series. So if you want to do the answer writing practice, it is a very good series for you all. Okay, Perspective 360, Monday, Wednesday, Friday at 5 p.m. for your answer writing practice of the descriptive questions of the recent topics, and a homework question is also given on which you can write the answer, and it is getting evaluated if you write the answer within 48 hours in the Perspective 360-degree series comment section. Okay, so this was the first question. Now this is the second question. Try to answer this question. So this is regarding the SEBI amendment that has happened in REITs and InvITs. Okay. So this is the second question. Now coming to the third question. So this is the third question. I hope you will be easily able to answer this question also. Okay. So try to answer this question. So these three questions are the homework questions. Read the question carefully and try to answer them. So thank you everyone. Thank you so much for joining the session. I hope you enjoyed today's session. If there is any confusion, any problem, you can comment down below. So do comment down below. What is happening? So do comment down below if there is any confusion you have, and do give the right answer of the 3 homework questions. Okay. So thank you everyone. Thank you for joining. See you in the next session.